China's Debt Dilemma, analyzing the 2023 economic forecast for potential bankruptcy in 5 key sectors. Introduction. China's economic landscape in 2023 is characterized by high debt levels and significant structural challenges that have led to concerns about the potential for bankruptcy in several key sectors. This report delves into the current economic forecasts, exploring the implications of China's debt dilemma across 5 critical areas: local government financing, consumer behavior, reliance on the US dollar, real estate, and structural economic challenges. 1. Economic performance and forecasts. In 2023, China's economy exhibited modest growth, with estimates ranging from 2.4% to 2.8%, falling short of the government's official targets. The slow recovery from the COVID-19 pandemic and the ongoing real estate crisis have placed immense pressure on various sectors. The forecast for 2024 suggests a slight improvement, with growth expected between 3% and 4.5%, contingent upon the government's stimulus measures, including a significant debt refinancing program aimed at local governments. Despite these efforts, deeper structural issues remain unaddressed. The reliance on debt to spur growth has raised concerns about sustainability, particularly as investments and consumption stabilize rather than recover fully. The anticipated bond issuance to restructure local government debts indicates an urgent need for fiscal reform, as local government financing vehicles (LGFVs) continue to struggle with decreasing revenues from land sales and investments. 2. Debt and local government financing. Local government financing vehicles represent a substantial portion of China's debt, currently estimated at around $8.5 trillion. The sustainability of these vehicles is in jeopardy due to plummeting revenues from land sales, once a primary source of funding, with local governments increasingly reliant on borrowing. The looming maturity of bonds and the need for refinancing create a precarious situation. The government's recent announcement of a $1.4 trillion refinancing program for LGFVs is a response to this crisis, aimed at alleviating the immediate fiscal pressure. However, analysts warn that while this could provide short-term relief, it does not resolve the underlying issues of mismanagement and over-leverage among local governments. The long-term implications of this debt load could lead to a wave of defaults if economic conditions do not improve, raising alarms about potential bankruptcies in the local government sector. 3. Reliance on the dollar. China's financial system remains heavily intertwined with the US dollar, with approximately 50% of its foreign exchange reserves denominated in dollars. This dependency complicates China's efforts to diversify its reserves into other currencies, like the euro or yen. Recent geopolitical tensions and U.S. sanctions against Russia have heightened fears within China regarding the potential for similar sanctions to impact its financial stability. Calls for de-dollarization have intensified, as some economists argue that reducing dollar exposure is essential for safeguarding China's economic sovereignty. However, despite attempts to increase the use of the renminbi in trade and finance, the dollar continues to dominate. The structural challenges of transitioning to a more multipolar currency system pose significant risks, particularly if the global demand for dollar assets remains robust. 4. Consumer behavior and domestic demand. Consumer confidence in China has waned, with retail sales experiencing declines as households grapple with high debt levels and stagnant disposable incomes. Government efforts to stimulate consumer spending through subsidies have thus far proven inadequate in reversing this trend. The increasing burden of household debt, coupled with uncertainties surrounding employment and income growth, has led to a cautious consumer environment. Despite the government's push to enhance domestic consumption, the underlying issues of rising living costs and insufficient wage growth continue to stifle spending. This lack of robust consumer demand poses risks for sectors reliant on consumption, including retail and services, heightening the potential for bankruptcies if the economic situation does not improve. 5. Structural challenges and authority bias. Analysts point to a critical evaluation of China's official economic data, suggesting an authority bias that portrays an overly optimistic view of the economy. Discrepancies between government reports and actual economic activity raise concerns about the reliability of data used to assess economic health. This bias has implications for how both domestic and international stakeholders perceive China's growth prospects. The property sector struggles local government debt issues, and weakened consumer demand exemplify the structural challenges plaguing the economy. Without significant reforms to address these issues, including enhancing transparency and accountability in economic reporting, the potential for widespread bankruptcies in key sectors remains a pressing concern. Conclusion. In summary, China's economic forecast for 2023 and beyond is fraught with challenges stemming from high debt levels, reliance on the dollar, and structural weaknesses. While the government has implemented stimulus measures to stabilize growth, these efforts may fall short of addressing the deeper issues at play. The potential for bankruptcy looms in key sectors, particularly local government financing, consumer-driven industries, and those reliant on stable economic data. As China navigates these turbulent waters, the path to sustainable recovery remains precarious, necessitating comprehensive reforms to foster long-term economic stability. Counterintuitive insights from China's debt dilemma and economic forecasts. 1. Economic growth versus debt levels. It may seem intuitive that higher levels of debt directly correlate with slower economic growth. However, China's situation in 2023 presents a counterintuitive image where extensive government debt, particularly through local government financing vehicles (LGFVs), is being used as a tool for stimulus rather than being seen as a hindrance. Analysts predict that despite the staggering debt levels, China may still experience modest growth due to aggressive refinancing and stimulus measures aimed at stabilizing the economy. This challenges the standard narrative that high debt equates to economic stagnation. 2. Consumer confidence and spending. Despite official reports suggesting consumer spending is recovering, the underlying indicators signal a decline in consumer confidence. Many expect that government subsidies will boost consumption, however. High debt levels among households and stagnant disposable income might limit the effectiveness of these measures. The paradox lies in the government's attempts to stimulate consumption through subsidies while consumers remain hesitant to spend due to financial insecurity, suggesting that consumer behavior may not respond as expected to fiscal stimuli. 3. The role of the US dollar. While the narrative typically suggests that reducing reliance on the US dollar is crucial for economic independence, China's financial system remains deeply embedded within dollar-denominated assets. Efforts to diversify away from the dollar seem to be met with significant hurdles. For instance, despite calls for de-dollarization, the sheer volume of dollar-denominated foreign exchange reserves and external debt severely limits China's ability to make substantial shifts. This reliance is ironically seen as a stabilizing factor in the short term, complicating the narrative that de-dollarization is an immediate priority. For authority bias in economic data, the expectation is that reliable economic data should reflect the reality of an economy. However, China's official economic statistics have come under scrutiny for potentially misleading portrayals due to authority bias, where positive narratives overshadow the true state of economic affairs. This bias creates a disconnect between reported growth figures and the economic reality on the ground, raising questions about the reliability of official data and suggesting that the perceived robustness of China's economy could be an illusion. 5. Investment trends. It is commonly assumed that increased investment leads to economic growth. However, the data indicates an alarming trend where investment, particularly in the property sector, is declining sharply. Despite official assertions of stable investment growth, the reality is characterized by contractions in significant areas such as property construction, which could have a cascading negative effect on overall economic growth. This challenges the notion that investment is uniformly positive for economic health and highlights the risks of sector-specific downturns. 6. Impact of international relations. While one might assume that geopolitical tensions such as US-China trade relations would uniformly hinder economic performance, the opposite may be true in specific contexts. China's industrial overcapacity has incentivized exporters to seek new markets, potentially creating opportunities for growth in sectors that could benefit from expanded trade relationships outside traditional partners. This presents a complex picture where international tensions could spur unexpected economic adaptations rather than outright declines. 7. Structural issues versus short-term recovery. Conventional wisdom suggests that short-term economic stimulus should lead to a robust recovery. However, the structural issues within China's economy, including overinvestment, demographic challenges, and a transition from an investment-led to a consumption-led economy, may inhibit lasting recovery despite any temporary growth spikes. The expectation for a cyclical recovery in 2025 might not translate into sustainable long-term growth, suggesting that policymakers face a critical challenge in addressing these underlying concerns. 8. Local government financing. It is often assumed that rising debt levels among local governments would lead to immediate fiscal crises. However, the situation in China suggests that local governments might leverage their debt for growth through strategic investments even as they grapple with repayment challenges. This dynamic creates a tension between short-term financial maneuvering and long-term fiscal sustainability, complicating the simplistic view that high local government debt inevitably leads to economic decline. In summary, the economic landscape in China is marked by a series of counterintuitive dynamics that challenge traditional economic narratives. High debt levels do not necessarily hinder growth, consumer behavior may not align with government expectations, reliance on the dollar persists despite calls for diversification, and structural challenges threaten the sustainability of any economic recovery. As China navigates these complexities, understanding these nuances is critical for comprehending its economic trajectory in the coming years. In examining China's economic forecast for 2023 and beyond, several critical aspects are often overlooked, yet they hold significant implications for the country's financial stability and potential bankruptcy risks across various sectors. Here are key points that deserve more attention. 1. Local government financing vehicles, LGFVs. Many analyses touch on the substantial debt associated with LGFVs, which has reached around $8.5 trillion. However, the intricacies of LGFV operations and their relationship with local government debt are frequently understated. LGFVs have been used as a means for local governments to bypass borrowing limits imposed by the central government, leading to a vast accumulation of debt that is often not transparently reported. The significance of this lies in the potential for a cascading failure if these vehicles cannot meet their obligations, which could lead to widespread defaults and exacerbate financial instability. As land sales revenues decline, the sustainability of these vehicles is under severe threat, and the anticipated bond issuance aimed at restructuring these debts may only serve as a temporary fix rather than a long-term solution. 2. Authority bias and data credibility. The concept of authority bias in China's official economic data is crucial yet often overlooked. Analysts frequently accept government-provided statistics at face value, which can lead to a misinterpretation of the economic landscape. This bias highlights the disparity between reported figures and the real economic conditions, particularly concerning GDP growth, consumer confidence, and local government fiscal health. As noted, there are significant discrepancies between official data and independent analyses, suggesting that China's true economic performance could be approximately 10% worse than reported. This undermines the perceived stability and growth of the Chinese economy, raising concerns about the efficacy of policy measures and the potential for crisis. 3. Consumer behavior and domestic demand. While the report mentions consumer confidence as a headwind, it fails to delve deeper into the structural factors contributing to this lack of confidence. Declining disposable incomes, rising household debt, and stagnant wage growth create a precarious situation for consumer spending. Moreover, the government's reliance on subsidies and short-term measures to stimulate consumption may not yield sustainable growth. The significance of this is profound. A weak domestic demand can hinder economic recovery and growth, leading to a vicious cycle of low investment and consumption. If consumers remain hesitant to spend, it could trigger a more severe economic downturn, increasing the risk of bankruptcy in sectors reliant on consumer activity. 4. Global dollar dependency. China's heavy reliance on the US dollar is often mentioned, but the geopolitical implications of this dependency are frequently understated. The report indicates that approximately 50% of China's foreign exchange reserves are dollar-denominated, which presents significant risks amid rising tensions with the US. As seen with sanctions against Russia, a similar strategy could be deployed against China, jeopardizing its financial stability. The push for de-dollarization and increased use of the renminbi in international trade is fraught with challenges, including structural limitations and the need for a robust alternative financial infrastructure. Should geopolitical tensions escalate, China's current dollar reliance could leave it vulnerable to economic sanctions, exacerbating the risk of bankruptcy in key sectors. 5. Structural economic challenges. The structural issues within the Chinese economy are often glossed over. While the focus on immediate growth targets is prevalent, the underlying problems, such as overcapacity in manufacturing, inefficiencies in state-owned enterprises, and an unbalanced economic model, pose long-term risks that are not adequately addressed in stimulus measures. The report's suggestion that economic growth could rebound to 3 to 4.5% in 2025 does not account for the need for substantial reforms to address these structural challenges. Without significant changes to the economic framework, any short-term gains may be fleeting, leading to further financial distress in key sectors, particularly manufacturing and real estate. In summary, while the economic forecast presents a cautious outlook for China, it is crucial to recognize the interconnectedness and complexities of these overlooked aspects. Addressing the risks associated with LGFVs, the credibility of data, consumer behavior, dollar dependency, and structural economic challenges will be essential for navigating the potential for bankruptcy in key sectors. These elements are not just theoretical concerns. They have real implications for China's economic resilience and global financial stability. 1. Local government financing and debt sustainability. One of the most critical points in understanding China's economic forecast for 2023 revolves around the issues surrounding local government financing vehicles, LGFVs. With an outstanding debt of approximately $8.5 trillion, the sustainability of these financing vehicles is under threat due to declining revenues from land sales and investments. The government's efforts to implement a debt refinancing program for local governments indicate an urgent need for restructuring. This structural issue exposes a broader debt dilemma that could lead to significant financial instability and potential bankruptcies within key sectors reliant on LGFVs. 2. Consumer behavior and domestic demand. The state of consumer confidence and domestic demand is pivotal for China's economic recovery. Despite government interventions aimed at stimulating consumer spending, such as subsidies, the fundamental issues of declining disposable income and high household debt levels pose major barriers to robust consumption growth. The challenging consumer environment, characterized by a lack of confidence and stagnant retail sales, highlights the critical need for effective policies that address these underlying economic concerns. Understanding consumer behavior and domestic demand will be essential for assessing the viability of China's economic recovery moving forward. 3. Reliance on the dollar and financial vulnerability. China's heavy reliance on the US dollar complicates its economic outlook and poses risks in the face of potential US sanctions. Approximately 50% of China's foreign exchange reserves are dollar-denominated, which creates vulnerability within its financial system. This dependence not only affects China's ability to diversify its reserves but also limits its economic autonomy. The ongoing discussions within China regarding reducing dollar exposure illustrate the urgency of addressing this reliance, particularly as geopolitical tensions escalate. Analyzing the implications of dollar dependence for China's broader economic strategy is crucial for understanding its financial stability. 4. Structural challenges and authority bias in economic data. the reliability of China's official economic data has come under scrutiny due to authority bias, which may distort perceptions of economic health. Discrepancies between government reports and actual economic activity raise questions about the true state of the economy and complicate forecasts. The reported economic growth rates may not accurately reflect underlying issues, such as high debt levels and sluggish investment. This skepticism regarding data credibility emphasizes the importance of critical analysis when interpreting China's economic outlook and the potential risks associated with relying solely on official statistics. Understanding the structural challenges and biases in data reporting will be vital for in-depth discussions about China's economic future. 1. The Great Depression 1929 to 1939. The Great Depression was a severe worldwide economic downturn that began in the United States after the stock market crash of October 1929. It led to massive unemployment, bank failures, and a dramatic drop in consumer and business spending. Governments struggled to address the crisis, leading to various economic policies, including the New Deal in the U.S. The economic turmoil had far-reaching effects on global trade and led to significant changes in economic policy and the role of government in managing economies. 2. The 1997 Asian financial crisis. This crisis began in Thailand with the collapse of the Thai baht, which led to a chain reaction of currency devaluations and economic turmoil across Asia. Countries such as Indonesia, South Korea, and Malaysia faced severe economic contractions, high inflation, and social unrest. The crisis highlighted vulnerabilities in the financial systems of emerging markets, leading to significant reforms in financial regulation and international monetary policies. 3. The Eurozone sovereign debt crisis 2010 to 2012. The Eurozone debt crisis was a multi-year financial crisis that affected several European countries, particularly Greece, Ireland, Portugal, Spain, and Italy. Triggered by the global financial crisis of 2007 to 2008, the crisis led to fears of sovereign defaults and necessitated international bailouts, austerity measures, and structural reforms. It raised questions about the sustainability of the Eurozone and the fiscal policies of member states, ultimately leading to significant changes in European economic governance. Future outlook: predictions for China's economic landscape post-2023. As we look forward to China's economic trajectory beyond 2023, several critical factors will shape the landscape, particularly concerning debt levels and potential vulnerabilities across key sectors. Below are predictions based on current trends and analyses. 1. Potential for bankruptcy in key sectors. Real estate sector. The Chinese real estate sector remains under severe strain due to high debt levels and declining property values. Predictions suggest that unless systemic reforms are enacted, several major developers may face bankruptcy. Local government financing vehicles (LGFVs) heavily reliant on real estate for revenue through land sales will also continue to struggle. This sector will likely see a wave of defaults, compelling the government to intervene to stabilize the market, thereby increasing national debt levels further. Local government financing (LGFVs) are predicted to come under increasing pressure as the economy stagnates. The anticipated refinancing measures may provide temporary relief, but without a substantial increase in revenue from land sales and a more sustainable model for local government financing, many LGFVs are at risk of insolvency. This could lead to a cascade effect impacting local infrastructure projects and social services, exacerbating public dissatisfaction. Consumer goods and retail. The consumer sector is expected to face challenges, with consumer confidence remaining low. Despite government efforts to stimulate household spending, including targeted subsidies, a significant rebound in consumption is unlikely. Predictions indicate that retail sales may stagnate, with a potential rise in bankruptcies among smaller retailers that cannot adapt to shifting consumer preferences and economic conditions. Manufacturing sector. The manufacturing sector may experience a temporary boost from government stimulus, particularly in the context of infrastructure projects. However, overcapacity and international trade tensions could stifle long-term growth. Companies heavily reliant on exports may encounter difficulties, particularly if US-China relations worsen, leading to more tariffs and restrictions. Banking sector. The banking sector will likely face heightened scrutiny as non-performing loans increase, particularly from LGFVs and the real estate sector. Regulatory reforms may be necessary to bolster the system's resilience, but a substantial rise in bad debts could trigger a banking crisis if not managed carefully. 2. Economic growth predictions. Short-term recovery. China's GDP growth is predicted to hover between 3% and 4.5% in 2025. Contingent on effective government stimulus measures and a stabilization of the property market. Growth rates may improve slightly if investments in infrastructure pick up and consumer confidence rebounds, but the ceiling will remain low due to entrenched structural issues. Long-term challenges. Despite short-term recovery, the long-term outlook remains cautious. Structural issues such as high debt levels, demographic challenges, and reliance on real estate for growth will persist, hindering sustainable economic expansion. Analysts warn that without substantial economic reforms, China may struggle to achieve the higher growth rates needed to maintain its global economic standing. 3. Debt and financial stability. Rising debt levels. China's overall debt is expected to rise as local governments continue to borrow to meet fiscal needs. The total debt-to-GDP ratio may exceed 300%, raising concerns about financial stability. Central government interventions such as bond issuances for debt swaps may provide temporary relief but not address the underlying issues. Debt restructuring. A wave of debt restructuring is expected, particularly among LGFVs. The government may implement more aggressive policies aimed at managing unsustainable debts, including bailouts or incentives for debt-to-equity swaps, but such measures could strain public finances. 4. Global economic relations and currency dependency. Reduced dollar dependency. China's efforts to reduce reliance on the US dollar are likely to gain momentum with deeper engagement in trade with non-dollar currencies, particularly the euro and yen. However, this transition will take time and face substantial hurdles, including geopolitical tensions and existing financial interdependencies. Trade relationships. The trade landscape will continue to evolve, with China seeking to diversify its export markets. However, the effectiveness of these strategies may be limited by global economic conditions and rising protectionism, particularly from the US and its allies. 5. Policy response and economic reforms. Increased government intervention. The Chinese government is expected to expand its role in the economy with significant interventions to stabilize growth. Measures may include increased fiscal spending, interest rate cuts, and targeted subsidies aimed at stimulating consumption and investment. Structural reforms. There is a pressing need for structural reforms to address fundamental issues such as overcapacity, environmental sustainability, and reliance on state-owned enterprises. However, significant policy shifts may be slow due to bureaucratic inertia and resistance from entrenched interests. Conclusion. In summary, while China may experience a modest recovery in the short term, significant challenges lie ahead. Key sectors face potential bankruptcies, and the debt dilemma will continue to cast a shadow over economic stability. Long-term growth will depend on the government's ability to implement meaningful reforms while navigating a complex global landscape characterized by shifting trade dynamics and increasing geopolitical tensions. The coming years will be critical in determining whether China can transition to a more sustainable and resilient economic model.